Good Sunday morning, and welcome to Dollars and Cents, where we help you make sense of all life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of different radio stations throughout Central Florida. We're also one of the top 25 financial planning podcasts on the World Wide Web, with well over 20,000 downloads. Woo, go us! So be sure to subscribe to our channel on your favorite social media platform of choice. If you have any trouble finding us, just go to our website, www.nelsonfinancialplanning.com. Look in the top right-hand corner, you should see a bunch of icons. Click on the icon that looks most familiar to you, and you will instantly get connected with our channel. My name is Garrett Fields. I'm a certified financial fiduciary. I'm set here with Kristen Cayley. She is also a certified financial fiduciary as well as a CPA at Nelson Financial Planning. Where our team of certified financial fiduciaries stands ready to help you change your life this week with a successful and cost-effective financial plan that provides superior investment results and provides you with peace of mind for the future. So, we have a lot to get to today. First off, we wanted to get to, obviously taking a look at the market. We're in a bear market. So we want to talk about 5 things that you could do to help out your portfolio during a bear market. We also want to go over, have your teachers and parents been correct? Should you pay super close attention to everything in your life, including your finances? Also, we want to talk about what's the chances of you getting audited? And what are 6 main things that'll throw red flags on your tax return? So before we get started, clearly we are in a bear market, so we want to recap exactly what that is. A bear market is whenever the market declines by 20% or more from its highs. So for example, let's just say that there is a index sitting around 5,000. It drops down to 4,000. That would be a 20% decline. That would put you into a bear market. And what about a bull market? A bull market is the opposite. So let's say that the markets ran up 20%. That would put you into a bull market. So in the situation, let's say index is at 5,000, drops down to 4,000, that puts you into a bear market, then goes up to 4,800, that's 20% from 4,000. You would then be in a bull market. And the way this cycle normally goes is you go bear market, bear market, followed by a, you got it, bull market. So, Kristen, I know you got a little bit of numbers for us. Tell us the average length of each bear and bull market.
Sure, Garrett. So the average bear market lasts 363 days, whereas the average bull market lasts 1,742 days.
So a bull market lasts significantly longer than a bear market. Okay. Well, what about percent loss and gains? What's the average percent loss and gains on a bear market? What's the average percent loss and gains on a bull market?
So bear markets typically lose about 33%, whereas bull markets typically gain about 159%.
Okay, so bull markets tend on average to outperform bear markets. Okay, good to know. Well, let's get into it. So we're in a bear market. We've been in a bear market since June 13th of 2020. That's whenever the market officially hit a 20% decline. So if you loved the securities at the beginning of January and you liked buying them at the price they were at the beginning of January, you're going to love where they're at now, because depending on the security, they could be down 20 or even more percent. So one of the things that you can do to help out your portfolio is you can buy more, right? But how should you do that? Let's say you have a good amount of cash sitting on the sidelines. Should you just dump all that cash in on any random Tuesday? No, of course not. So how do you get that invested? Well, let's say you have $10,000 sitting on the sidelines and you really want to get that invested. You really want to put that into your favorite security because it's down and you can buy more for your money. How should you do that? Well, we recommend dollar cost averaging. That's whenever you take the money that you have, you divide it up into segments, and you piecemeal it into the market. So let's just say you have $10,000 in this example, and you want to put it into the market. Well, you could take that $10,000 and you can divide it up into little bits. So let's just say $1,000. So you can put in $1,000 this month, $1,000 the next month, and then keep doing that in 1 month increments, so that in 10 months you've pushed in the full $10,000. Well, you would say, why would you do that? Well, there's a couple reasons. One, so let's say that you put in your first batch of $1,000. The market can do one of two things. It can obviously either go up or it can go down. Well, if it goes up, that's great. You made extra money on the extra money that you put in. So you're good. Well, if the market goes down, well, now you have more cash to continue to throw in and buy at an even better price. So, it's important to dollar cost average also from an emotional standpoint. If you just push all the money in on a Tuesday, Wednesday, you're going to be looking at that like a hawk. You want to know what's going on, and that can kind of throw you off just a little bit. So there's a bunch of reasons why you want to dollar cost average, just a little bit safer and get you a much more average cost basis. So that's number one. Moving on to number two, diversity in holdings. So I'm sure, as you've noticed, you have multiple different holdings in your portfolio, or at least you should. And you've probably also noticed that each one of the portfolio, or each one of the holdings in your portfolio has gone down a little bit differently, right? So let's just say that you have a growth fund in your portfolio, and let's just say you have a short-term bond fund in your portfolio. The growth fund has probably gone down significantly more than the short-term bond fund over the course of this year. So if you're someone that either needs income or for some reason you need money out of your portfolio, what's going to be the best place to take it? It's probably going to be from the short-term bond, because that hasn't been hit nearly as much. So instead of taking it from a growth fund or a position that's been hit really hard this year, take it from another position that's hanging in there a little bit better. That's going to give your positions that have been hit really hard time to recover, and it's just going to give your portfolio a better rate of return over time. So make sure that you have diversity in holdings. Another thing that you can do, and this, you might need a little bit of setup for this prior to the bear market, but invest in sectors that perform better during bear markets, or at least hang in there better during bear markets. So according to NerdWallet, they laid out a couple of these sectors. One was consumer staples. They said that consumer staples typically, on average, hang in there a little bit better during bear markets. And utilities, that's another one. They say both of those hang in there a little bit better during bear markets. So if you're concerned that the market's going to have a pullback here soon, or coming up, is what you could do is you could change your portfolio, or you could change some of your holdings from where they're currently at to some of these a little bit more defensive sectors, just to be a little bit more defensive. Right? Well, okay, so what's number four? So number four is keep in mind what this portfolio is used for. If you're in your 50s, or you're in your 40s, or even if you're in your 60s, and this is a retirement account, you're going to have 20 to 30 plus years that this money is going to need to be invested for. So don't completely throw the game plan out the window just because of a 6-month period. The reality is that these, as we looked at earlier, the bull markets are typically stronger and typically last a lot longer than the bear markets. And if you're following the pattern earlier, normally it goes bear market, bull market, bear market, bull market, bear market, bull market. And if we're in a bear market, the next thing that's going to come is a bull market. So don't completely just throw the game plan out the window just because of a 6-month period. And also keep in mind what parts of your portfolio are there for. So if you need cash over the next 3-ish years, let's just say, that money really shouldn't be invested. Or if it is invested, it should be invested very conservatively. But whenever we come back, we're gonna go over the 5th thing that you can do to help out your portfolio during a bear market. This is Dollars and Cents, and we'll be back with you just in a bit. Welcome back to Dollars and Cents, where we help you make sense of all life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you from a host of different radio stations throughout Central Florida. We're also one of the top 25 financial planning podcasts on the World Wide Web, with over 20,000 downloads of our program. Go us! So be sure to subscribe to our channel on your favorite social media platform of choice. If you're having any trouble finding us, just go to our website, www.nelsonfinancialplanning.com. Look in the top right-hand corner, you should see a bunch of icons. Click on the icon that looks most familiar to you, and you should instantly be connected to our channel. My name is Garrett Fields. I'm a certified financial fiduciary with Nelson Financial Planning, and I'm sat with Kristen Cayley, who is also a certified financial fiduciary and a CPA at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you change your life this week with a successful and cost-effective financial plan. that produces superior investment results and provides you with peace of mind for the future. So on the first segment, we were talking about some things that you could do to help out your portfolio in a bear market. We talked about dollar cost averaging, diversity in holdings, investing in different sectors, and making sure that you're staying the course, making sure that you're focused for the long term. So what's the fifth? The fifth is probably the most complicated of them. It's tax loss harvesting. So let me explain what tax loss harvesting is real quick. Tax loss harvesting is whenever you sell a security at a loss on purpose to offset some gains that you might have received earlier in the year. So let's say that you have a security that you sell, January 4th, January 5th, earlier in the year, and you sold it for a profit. And now your securities are down. Well, something that you could do is you could sell another security, a different security, at a loss, if it's at a loss, to offset some of those capital gains. So a couple things to keep in mind when you're doing this. First off is how long you've held the security for, because depending on how long you've held the security for determines what type of capital gains it is. If you've held it for under a year, that's going to be short-term capital gains. If you've held it for over a year, that's going to be long-term capital gains. So that's key to keep in mind. Another thing is keep in mind when the transactions are happening. So if you want to tax loss harvest in 2022, because you sold a security at the very beginning of 2022, you need to sell the tax loss harvesting security by the end of December 31st, 2022. So both transactions have to happen within the same calendar year. They have to happen in 2022. Something else to keep in mind, you can actually reduce your taxable income if you don't have any capital gains. So if you're single or married couples, you can deduct up to $3,000 in tax loss from your ordinary income. If you're married filing separately, you can deduct up to $1,500 per person. Well, let's say that you have extra losses at the end of the year that you didn't get to deduct. You can actually roll that over to the next year in increments of $3,000. So that's pretty good. What's another benefit of tax loss harvesting? Another benefit is that you can actually free up some cash in order to buy different assets. So if you sold a security at a loss, now you have some cash to buy different assets or another asset that you think is going to perform better in the future. A couple things to be worried about and to be careful here. You cannot buy the same security. So let's say that you sold Apple or something along those lines for a loss this year. You cannot go back and buy Apple again for at least 30 days. That would be a wash sale, which essentially is going to nullify the tax loss harvesting during that time period. But what you can do is, let's say you sold one company, you can go out and you can buy another company that's similar or maybe even possibly down more instead. So you can sell that company to tax loss harvest to offset your taxes. And then you can take the cash that you got from that sale and buy another security that's either down more or similar. It's going to have a similar recovery, as to not lose that recovery. So another thing, so that's important, wash sale, don't do that. But another thing that you need to keep in mind is your cost basis. So a cost basis is essentially the price that you paid for that security. A couple of things that you got to keep in mind here. You got to keep in mind when you bought it, because obviously you want to have it for over 12 months, you want to have it for over a year. How much you bought and what the price was, right? That's going to be your cost basis. Well, if you bought it all in one chunk, that's going to be pretty easy to calculate. But if you bought it maybe by dollar cost averaging, that's going to spread out the cost basis over a longer period of time, and you're going to have to go through and calculate that. Luckily, most brokerages will calculate it for you. So that's tax loss harvesting. And we said at the beginning of the program, the other thing that we wanted to talk about is, are you paying too much attention to your investments? So as we discussed before, we are in a bear market. So Kristen, since we've been in a bear market, have you been looking at your portfolio more recently?
Yes, absolutely. I'd say yes.
Yeah, I would say that that's a pretty common thing. When the market's down, you gotta watch your investments, right? I mean, you gotta be on top of that like a hawk. We've been told by our teachers, by our parents, by everyone that we've met that, hey, listen, you gotta pay attention. If you don't pay attention, if you don't know what's going on, you're going to miss something. If you miss something, that's going to go really, really bad, right? We've all been told that. Is that particularly true with everything? Let me ask a question. Fellas, should you pay attention to every dollar your wife spends? And ladies, should you pay attention to how much time your husband spends watching sports? Of course not. That's not a good thing to pay super fine attention to. But what about your finances? That's pretty important, right? That's a huge part of your life. You got to be on top of that like a hawk, right? Well, according to the New York Times, they would say that you're actually wrong. They're actually saying that paying too close attention to your finances can have a negative impact on them. How can that be? Well, this is where I need to introduce a concept called behavioral economics and loss aversion. So the best way to explain this is, let me give you an example. Let's say you're walking down the street and you find $100, right? You're going to be very joyful. You're going to be very happy that you found $100. That's a normal reaction. Well, let's say you're walking down the street and you have $100 and the wind blows it out of your hand, blows it right into a gutter, or you just lose it. You're going to be pretty upset that you just lost that $100. Well, logic would tell you that the pain of losing that $100 should equal the joy of gaining that $100, right? It's both the $100, it's the same amount of money, it shouldn't really matter. That's not necessarily the case. You're actually going to feel a lot more upset about the $100 you lost than you are about the $100 you gained. So, and this can pretty easily be translated into your portfolio. If you're looking at it too often, you're just not going to have a good rate of return. You're going to start selling your riskier assets, and it's not going to be a good time. So what's going to happen is your riskier assets like stocks are often going to have a lower return than your safer assets like bonds. And you might say, okay, this might be true for new traders or people getting into the market, but what about me? I'm a seasoned professional, or I'm a seasoned investor, or I'm a professional. Surely that can't have that kind of impact on me, right? Well, that's not necessarily the case. According to a lab-filled experiment done by them, they would say that even the most seasoned professionals fall prey to this loss adversity. So even seasoned professionals that like to take a look at their portfolio, multiple times a day or even multiple times in a week, they're going to fall prey to loss aversion. So they are going to invest in less risky assets. They're going to make their portfolio more conservative than it needs to be because of this loss aversion. So what's the answer then? Am I saying, don't ever look at your portfolio and just hope that whenever you get to retirement, you hope that you have enough money? No, of course not. But, we think that a good time to look at your portfolio is probably once every 3 months. And that's what this article is saying as well. So when your statements come out, that's going to be a good time to look at it. Whenever you're meeting with your advisor, probably 2 times a year, 1 or 2 times a year, that's going to be a good time to look at it. Toning down the amount of times that you look at your portfolio to maybe 6 times a year, that's probably going to be a good number. Now, there are going to be some particular circumstances where you're obviously going to want to take a look at your portfolio. One of those being, if there's a death in the family, if you're getting married, if you're having a child, or if you're switching jobs. Those are obviously going to be good times to look at your portfolio. And when we come back, we're going to take a look at 6 things that could cause your tax return to be red flagged and what's your chances of getting audited on Dollars and Cents. Good morning. This is Dollars and Cents, where we help you make sense of all life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of different radio stations throughout Central Florida. We're also one of the top 25 financial planning podcasts on the World Wide Web with well over 20,000 downloads of our program. Go us. So be sure to subscribe to our channel on your favorite social media platform of choice. And if you're having any trouble finding us, visit our website, www.nelsonfinancialplanning.com. Look in the upper right-hand corner, you should see a bunch of icons. Click on the icon that is most familiar to you, and you should become instantly connected with our channel. My name again is Garrett Fields. I'm a certified financial fiduciary, and I'm sat here with Kristen Cayley. She is also a certified financial fiduciary and a CPA at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you change your life this week with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind in the future. So is what we've kind of gone over so far is we've gone over the 5 key things that can help your portfolio during a bear market. We also went over how much attention you should be paying to your portfolio. It's probably less than what you thought. And now we're going to get into what's your chances of being audited.
Thank you, Garrett. Yes, so a very popular question CPAs get from their clients are, what are my audit chances? Our response is always, don't take chances on your tax returns, but we'll give you the stats on today's show anyway. So it's no secret that the IRS is suffering from staffing shortages and major underfunding. So what impact does that have on IRS audits? And what triggers an IRS audit in the first place? So today we're going to take a look at how IRS audits have changed over time and what type of tax returns have the highest audit rate and why. So we'll go over the top 6 reasons why the IRS could flag your return for audit as well. So what are my audit chances? The overall trend since 2010 is that audit rates are on the decline. And the decline is the sharpest for the highest income earners. So the Government Accountability Office, this is a federal watchdog, put together a report that compared IRS audit rates in 2010 to 2019, so over a 9-year span. So overall the rates went down. So the rates for individuals were 0.9% in 2010, and that dropped down to 0.2% in 2019. So in terms of tax returns, this means the IRS audited around 1.27 million returns back in 2010, and then less than 387,000 in 2019.
Wow, that's a significant drop. But that's got to be good news, right? I mean, less audits, that's got to be good news for everyone. Less people are getting audited. What is there a catch? What's the catch here?
There's always a catch. So let's break down those percentages some more. So the audit rate for the highest earning Americans making over $5 million a year was just over 16% back in 2010. So this has dropped down to a staggering 2% in 2019, which means that these highest income earners are 88% less likely to be audited now than they were back in 2010. And we see a similar trend for income earners making between $200,000 to $500,000. Their audit rate declined 92% since 2010. So that seems pretty good for those high income earners. However, the audit rate for lower income Americans, particularly those claiming the earned income tax credit, did not share in that steep decline.
And real quick, before we go any farther, refresh my memory. What is the earned income tax credit again?
So this is a credit that is claimed on your tax return. And it really is aimed to help lower income Americans offset their tax liability. So this is a credit, depends on your marital status, your income, and also your dependents, so your family size. So let's just give an example. So in 2021, let's say a married couple with 2 kids making about $53,000 a year, they'd probably be eligible for a credit up to $5,900 or so.
Got it. So it's a tax credit that helps lower income families, especially those families with children. So what's been the trend for the lower income audit rates?
So those claiming the earned income credit saw audit rates drop only 58% since 2010. So compare that to the higher income earners who saw audit rates drop up to 92%. So returns claiming the earned income credit are about 4 times more likely to be selected for an IRS audit than somebody making between $200,000 to $500,000.
Wow, 4 times? That's crazy. Why 4 times?
A variety of reasons. So the earned income tax credit has historically been a huge fraud area. So looking back between 2006 and 2008, so before the study even starts taking its sample pool, the IRS found that up to 50% of tax returns claiming the earned income tax credit involved erroneous overclaims that were meant to receive a higher credit or refund than they were allowed. So they do this by reporting fake income, stealing social security numbers to create a fake family, or even with the help of corrupt CPAs who are looking to get their clients a larger refund so that they can get paid more. So we saw something similar actually recently with the COVID stimulus checks. Many fraudsters were kind of taking advantage of all this money being thrown out, and they were filing tax returns for deceased people to try and get that recovery rebate credit. So the stimulus checks, much like the earned income credit, they're aimed to help low to mid-income Americans. So as a result of all this fraud, the IRS cracked down and instated penalties, not only for the taxpayers, but also for CPAs when it comes to this earned income tax credit. So it makes sense that the earned income credit fraud has dropped to about 20% now. It used to be up at 50%. And it makes sense that it's kind of a more audited area.
Sounds like some of the IRS measures have helped reduce fraud. So why is the earned income tax credit so heavily audited? You'd think that they go after, some bigger fish for some more money, right? That would make the most sense.
The IRS says it's because of lack of funding. So the IRS officials explained that the earned income tax credit, it takes less time for an audit and they get higher tax revenue per audit hour. So essentially these earned income tax credit returns, they're kind of like low-hanging fruit for the IRS revenue agents. So think about it. If you fall into this category, you might not have a CPA. You might be using some free online software like TurboTax, H&R Block, or you could even be preparing your own tax return by hand. We still see a few of those come through. So let me tell you, this is not an easy tax credit to calculate. There's a lot of different factors that go into it, a lot of different limitations. So there's 2 separate limitations just based upon your earned income and your investment income. So multiple factors, so I can see how errors and math mistakes could cause somebody to think that they're eligible for the credit, but they're actually not. So the most common accidental errors that relate to this credit come by reporting children as dependents. So we kind of see this when maybe the child gets too old, or maybe the child gets a part-time job and files their own return, or maybe somebody's claiming the child twice. So this is the case for divorced parents. So if the IRS sees a discrepancy, they're going to send you a letter and they're going to say you owe this tax bill. So if you've ever received a letter from the IRS, you know that they're a little scary, they're hard to understand. You do have the option to respond and challenge the IRS, but many just pay the bill and move on.
Got it. Well, so let's recap. The IRS audit rates are down across the board, but not equally among all income ranges. If you're a higher income earner, your chance of getting audited by the IRS is slim to none. But if you are a low income earner claiming the income tax credit, you are 4 times more likely to be selected for an audit by the IRS than any other group. That's just terrible. Is the IRS doing anything to fix this?
There's been some legislation thrown around to impose an 8% audit rate on those making $10 million or more. Also proposals to increase the IRS budget. All these proposed changes are done with the intent to increase the audit rate, right? You're more likely to comply with the tax laws if you think you're going to get in trouble if you don't follow them.
Yeah, that's true. If I feel like there's a higher chance of me getting audited, you're probably going to follow that much more closely. I definitely, personally, do not want to get audited by the IRS. They scare me. They're scary. If you have any questions about your tax situation, our team of certified financial fiduciaries and our CPA are available to help you navigate the tax world. On our next segment, we're going to go over the top 6 reasons why the IRS might flag your return for an audit. So stick with us. Welcome to Dollars and Cents, where we help you make sense of all life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a host of different radio stations throughout Central Florida. We're also one of the top 25 financial planning podcasts on the World Wide Web, with well over 20,000 downloads of our program. So be sure to subscribe to our channel on your favorite social media platform of choice. And if you have any problems finding us, visit our website, www.nelsonfinancialplanning.com. Look up in the top right-hand corner. You should see a bunch of icons. Click on the icon that looks most familiar to you, and you should become instantly connected with our channel. My name again is Garrett Fields, and sitting with me is Kristen Cayley. We're both certified financial fiduciaries, and Kristen's also a CPA at Nelson Financial Planning, where our team of certified financial fiduciaries stands ready to help you change your life this week with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So, welcome back to the program. We just finished going over how the IRS audits have changed over time. And we have some good news to report that the IRS rates have decreased over time. Kristen, recap some of the specifics for us.
You're right. So audit rates are decreasing, but if you claim the earned income tax credit, you are still more likely to be audited by the IRS than any other income group. And this is just because it has a history of fraud and it's really easy to make mistakes on it. So this kind of leads us into our next topic. So the top 6 reasons why the IRS could flag your tax return and how to avoid these 6 red flags. So the first being mistakes on your tax return. So we just touched on this with the earned income tax credit. Intentional misreporting related to your dependents or your income can be very costly with penalties, not only for the taxpayer, but also for the CPA. So math errors or data input errors can trigger an IRS notice, basically stating the corrections. So for example, let's say you transpose a 6 for a 9. The IRS will send you a letter basically saying, this is what we calculated, this is what you calculated, here's the difference, and here's what you owe us. Or in some other cases, this is what the IRS owes you. A simple math or input mistake usually won't trigger a full-blown audit, but that will flag the IRS to look at your return more closely, and this will slow down your refund if you are owed one. Inputting numbers can be pretty costly, which is actually why we invested in tax software with pretty good technology that can identify certain input mistakes, as well as it can even recognize certain numbers on the tax forms.
Yes, technology certainly helps with accuracy. We'd recommend that everyone use some sort of tax software to do their tax return. It's just more accurate. We know some people are still out there doing your taxes with pen and paper, and that's okay. The IRS doesn't joke with mistakes though. So what's the next reason?
So the next reason is missing information on your tax return. So this could be as simple as missing a tax form. So we've seen this with people rushing last minute. It's really easy to forget that you may have opened a brokerage account last year, and that brokerage account may have issued you a tax form. So it makes it even more difficult nowadays when a lot of these online platforms, they just post the tax forms online. They don't mail it to you anymore. So without that physical mailed form, it's kind of like you need to double check yourself. So many times we have to redirect the client back to whichever online website they use to obtain these documents, because they don't even know the documents exist in the first place. So we saw this a lot this past tax season with PTPs. These are publicly traded partnerships. So PTPs operate similar to a stock. You can buy and sell them on any sort of brokerage platform. The difference being is with PTP investments, they are not only issued your typical brokerage 1099, but they're also issued a separate K1. This is outside of the brokerage account, and the investor must individually obtain this Schedule K from the PTP itself. So we also saw that a ton of 1099s were being issued more frequently. So if you participated in something like a research study, or even if you donated blood that paid out a stipend or a bonus incentive, this could trigger a 1099. So it's really important that when it comes to tax time, you really take a step back and think about the past year and kind of think about not only just your jobs or your investment actions, but think about anything that you may have been paid for, or also any of your education costs. So make sure you have all your tax forms before filing your taxes. And remember that some of these tax forms might just be on your online account. Another important thing to remember is that the IRS has a copy of all of these tax forms. So whether or not you physically have a copy, the IRS will know if you miss a tax form on your return.
I did notice a big uptick in 1099 this year, and now you're answering a 4-month-old question that I have, because I actually did get a 1099 from Ticketmaster for selling the concert tickets. First time I've ever seen that, definitely threw me off guard, was unsure what to do with it. I did end up filing it, obviously. But so what are some other things that we can look out for in the future? What's number 3?
So the next one is, it's a red flag area if you are a self-employed business. And this is just because self-employed businesses can offset income with legitimate business expenses. Keyword here is legitimate. So a typical red flag is deducting 100% of your only car. So let's say you do use your car for work. It's reasonable to say 25 or maybe 50% of your vehicle is used for business purposes. Doesn't really make sense if you deduct the full 100%. So that's kind of a red flag area. Another area that could flag the IRS is high meal expenses or the home office deduction. So a good rule of thumb is to keep all your receipts and use a bookkeeping software. So the fourth reason kind of piggybacks off the third one. So this also relates to self-employed businesses. So if you claim too many business losses over the years, so claiming too many expenses that can generate multiple years of business losses can be a red flag for the IRS. So let's take a look at Schedule C. So this is on the individual 1040 tax return. The IRS has a general standard that in order to be considered a business for profit, you should be reporting income in 3 of the past 5 years. This is a pretty general standard. So if your business starts reporting losses over multiple years, so over 3 years in a row, the IRS starts to ask the question, is this a business or is this kind of more of a hobby? So it's kind of easy for the IRS to catch these things now. I mean, they have all of your tax data. So if you're filing 1040s, they're going to keep them on file. It's easy for them to look back and kind of take a look at the past 5 years and see if you reported income out of the past 3 years. So I think this is the way that the IRS is heading. They're really trying to crack down on all these excessive business expenses.
Sounds like it. The S-corp basis requirement, that's new for this year, right?
Yeah, so starting in 2021, every S-corp basis owner, S-corp owner was required to submit Form 7203. So this was a form that was attached along with the 1040. Kind of does the same thing as what we just mentioned with the Schedule C. It's basically a cumulative profit and loss over time. So this is required now to be attached to the 1040. So it basically says if your S-corp has cumulative profits or cumulative losses. So basically the IRS saw that S-corps before did not have this requirement, were taking excessive losses. So they took a step back and said, there's got to be a way that we can require them to report this sort of information. So back in 2017, 2018, the IRS started hinting that they'd require these basis schedules, but they finally implemented it this past year.
So what happens if the IRS catches you for too many years with a loss?
Nothing good. So you'll have to prove that you are a legitimate business with expected income in the near future. Remember, the IRS wants you to report income. So if you can prove that your business is just in a startup phase or in a recessionary period, but you confidently plan to have more reportable income in the future, could satisfy the requirements. But the worst case scenario is if you fail to prove your case to the IRS. So they may go back and remove every loss from your tax returns. So that could generate a pretty big tax bill with interest and penalties.
Definitely want to steer clear of that. I believe that's all the time we have today. This is Dollars and Cents. Thank you so much for joining us.